Joining us now, Dave Mazza, Chief Strategy Officer at Roundhill Investments, to talk more about the year that we've seen and what we may yet see. Dave, great to see you. Thanks so much for being here. It's good to talk to you on the last trading day here. So we have seen, as we have been talking about, this domination of the Magnificent Seven, and we have been trying to figure out what happens in 2024 with not just that group, but sort of the group around it. What's the next hotness in the market, Dave?
No, you're absolutely right. I think first and foremost, we've talked ad nauseum about how surprised everyone was with the great performance of the markets, really led by that AI trade and the Magnificent Seven group. But when we start thinking ahead to 2024, I actually think we're going to end up in a market that is bifurcated like we've continued to see, but in a bit of a different way. So until we see those rate cuts, there's no reason why the Magnificent Seven stocks likely may not continue to outperform, even if people are uncomfortable with that, right? They were unloved at the beginning of the year. The flows weren't there until recently, and now they've started to come because everyone was hanging out in T-bills and money market funds to earn a yield that they hadn't gotten in decades. That begins to change, though, when those rate cuts begin to happen, which could be as soon as the spring, if not the middle of the year, if we start to see some of this economic data continue to fade, because we know that that Scrooge of inflation has finally started to come down.
Well, the Scrooge of inflation is coming down, but the market doesn't seem to be interested in looking at the real Scrooges. And I'm curious your take on this idea that if the good news is making the market go up, why would you worry about any of the Scrooges in the room? Something like narrowness in the rally. What is your take on the market's ability to ignore any of those negative realities that could be to come?
Yeah, no, you're spot on. The market, I think, has done an excellent job of focusing actually on some of the fundamentals. And some of the fundamentals, as surprising as that may seem, have been that we're actually out of the earnings recession. The most recent earnings season, it was really, again, powered by the Magnificent Seven, those big tech giants, which are not just one company, but in many cases, 5 to 10 companies combined into one publicly traded company, which is a bit of the reason why they may be misunderstood as a group. That is really beneficial, because now we actually see further earnings growth and further revenue growth on the horizon. When you couple that with a decrease in inflation, even as we start to see some employment data begin to perhaps tick up, those are actually all positives. The one big negative and question mark that's out there that never happened this year, that certainly at some point is going to have to come home to roost, is the consumer, because we are beginning to see some signs there of some stress, right? We know that there is subprime auto loan delinquencies. We know that credit card spending is increasing. We know the use of buy now and pay later is increasing. So the stress in the consumer is starting, but for the time being, we're not seeing it. And that's one of the reasons why valuations in the market have gone up so sharply this year. But we're going to need to see those earnings and revenue growth continue to come if we expect the market to power higher.
So, Dave, when we talk about places to look in 2024, I know one of the places you're looking is at high dividend payers, and specifically what we're calling dividend aristocrats, which sounds very fancy. What do we mean by dividend aristocrats? Is it consistent dividend? Is it growth in dividends? What are you focusing on?
Yeah, no, it's exactly the consistency of the growth that makes a dividend aristocrat. So a dividend aristocrat is a company that has increased their dividend each and every year for 20 or 25 years. There's another group, even stringent to get in, the dividend kings or the dividend monarchs. That's 50 years of consecutive dividend increases. And why am I looking at that group as an option away from the Magnificent Seven, even if the base case is that the Mag 7 continues to power the market higher, at least in the beginning of 2024? It's because they tend to be incredibly resilient. If you've been able to increase your dividends for that long of a time period, you have strong free cash flow to be able to pay those dividends to investors. And what's interesting is that those names have been incredibly out of favor. In fact, the S&P High Yield Dividend Aristocrats Index had its worst ever relative performance compared to the S&P 500 going back on record last year, because they had that index has no exposure to Magnificent Seven, underweight names like technology, and overweight staples and utilities. So when you get rate cuts, those are the sectors that historically do well. I am still concerned. Everyone's saying, well, let's rotate out of the mega caps and go buy small caps. Generally very logical. The challenge is that many small cap companies remain unprofitable. They remain actually challenged because there's such an overweight to regional banks and biotechs. And there's some question marks about just moving into the small cap space. So if I'm looking to rotate, I actually want to stay with high quality names, which you're going to find with the elite dividend growers in the aristocrats and dividend monarch space.
Yeah, I guess another way to look at that, Dave, is that there's nowhere to go but up when you talk about that comparison to the broader S&P 500. I'm curious, though, dividend plays to me spell safety, spell conservative, which indicates to me that you might have a recessionary take on 2024. How are you squaring your view of the broader 2024 macro outlook with your view on the upside for dividend plays?
Yeah, no, you raise an interesting point because historically the best performance for high growth and high dividend names have come in down markets, right? So actually in 2022, they had great performance, incredible relative performance compared to the S&P 500, and that reversed in this year. So when we start to think about 2024, the macro, I do think we start to see the catch-up of the consumer happen somewhere around the spring to the middle of 2024. But the Fed is really trying to thread this needle. And they've done, and there's a lot of naysayers out there, they've done a great job with trying to engineer this soft landing to date. The challenge begins, and we were talking about that in the segment before, we have the election coming. We know the Federal Reserve has a ton of political pressure on it, even if they do their best to ignore it. And that only grows when we think about the likely candidates coming in the next election cycle. And so I think they may actually end up getting themselves in a rock and a hard place with beginning their rate cuts when you're too close to the election, because I don't think they want to be seen as influencing it to a great extent. So we may end up in an environment where the consumer starts pulling back at sort of the worst possible time for the Federal Reserve, which is why I'm less favorable on markets in the second half of 2024 compared to the beginning of 2024.
Yeah, Dave, you make a great point that we've heard a few guests talk about, which is the politicization of the Fed. Regardless of whether or not they like it, it is an election year next year. So interesting to watch. Dave Mazza, really appreciate it. Thank you and Happy New Year.